All right, so let's take a look at the chapter 3 homework. This is problem number 1. And in this problem, we're going to work on looking at the concept of a T account. And so what they give us here is they give us the following account balances. You've got cash, equipment, accounts payable, and capital. And down below, you can see you have the various T accounts. So just kind of like as a reminder, let me just do something real quick here. So just remember, if we would draw a T account, and remember that the left side of the T account is the debit and the right side of the T account is called the credit. And the normal balance of any account is always said to be what they say to be is the increase side. And so go back and review the lecture PowerPoint on the debit and credit rules. But for example, when you look at cash, it's got a balance of $76,000. Cash is an asset, and assets increase on the debit side. So notice how they go ahead and they enter that cash balance on the debit side of the T account. Same thing on equipment. Equipment's also an asset. And so notice with equipment, they go ahead and enter that on the debit side of the T account. Now, accounts payable, which is a liability. Remember, for assets, the general rule goes increase debit, decrease credit. For a liability, remember, like accounts payable, it's going to be just the opposite. And so it's going to be increase on the credit side and decrease on the debit side. So remember, you always have the balance on the increase side. So for the accounts payable, you'll notice that $96,800, they went ahead and they put that on the credit side. And likewise, the same thing with capital. Capital increases on the credit side because that's an equity item. And so notice that they also put that on the credit side of the T account. All right, so that is problem 1. Let's check out problem number 2. And on this problem, we're going to talk first about the concept of, they give some transactions, and we're going to talk about the debit and credit part of it. And then on the second part, we're going to go ahead and put these transactions into T accounts. So again, on the first one, let me get my stylus. It says Hayden invested $90,000 cash in the business. And just to kind of recap, these are the same types of transactions that you would have seen in chapter 2. It's just now we're applying, of course, the debit and credit rules. And so down below it says, which 2 accounts would be affected? Of course, it would be cash, debit, capital, credit. Second one, paid $30,000 in cash for equipment. So we're going to have cash and equipment both involved. So we're going to be debiting equipment because it's going to be increasing, and crediting cash. Transaction 3, perform services for cash for $9,000. Perform services is, of course, revenue. And the revenue account that we've been using is the fees income account. And we got cash. So notice we're going to be debiting or increasing cash and crediting your fees income account. Number 4, paid $3,800 in cash for advertising. So cash is going to be reduced or credited, and your advertising expense is going to be increased or debited. So notice they're going to say debit advertising expense and credit cash. Last one, paid $3,000 in cash for supplies. And of course, you're going to be increasing supplies, debiting, and then crediting cash for the $3,000. And so then when you go and look at the T accounts, let me kind of pull this down here. You can see where all the different debits and credits ended up. So you can see they labeled, and you can trace the transactions. So the first one there is your cash investment. There's the 90 there, that's the debit. Notice there's the credit offset on the capital. On the second one, you had equipment. There's the 30,000 debit. And how they pay for that, it was with, it looks like it was with cash. So there's the credit to cash. The third one, here's your debit to cash. And the offset to that will go down here to fees income. There's your credit, just to kind of show you that. Fourth one, you had a credit to cash of $3,800, and the debit offset would have been to your advertising expense. And then of course, the fifth one, you had a credit to cash of $3,000, and then a debit to supplies of $3,000. Now, the other thing that they do in this chapter is they show you how you calculate the balance of an account. And so, for example, for cash, you've got 90,000 and 9,000 debits, and then you've got 3 individual credits. So what you do is you add up your debits, you add up your credits, you take the difference. The difference, notice it's on the increase side of an asset, which is cash, is going to be 62.2. Your equipment it only has one debit, so that is the balance. And I guess the rest of these, you only had one transaction. So supplies, that's the balance, capital, advertising, and of course fees, income, and note which side that the balance is on. It's always going to be on the increase side of that, whether it's an asset, liability, or an equity item. All right, that was number, what, 2? Let's check out number 3. And number 3, again, we're getting into that concept of normal balance. Remember, the normal balance is always the increase side. So when we go through these, we'll say, first of all, is it an asset, liability, or capital item? So cash is an asset. Assets increase on the debit side, so it's a debit balance. Capital increases on the credit side, so it's a credit balance. Fees income, which is revenue. Revenue always increases on the credit side, so it's a credit balance. Accounts payable. It's a liability. Liabilities increase on the credit side. Supplies is an asset, increases on the debit side, so it's a debit balance. Equipment's an asset, again, same thing, increases on the debit side, so it's a debit balance. Accounts receivable is an asset, increases on the debit side, so it's a debit balance. And then salaries expense increases on the debit side, so it has a debit balance. So it might help if you go back and review the debit and credit rules in the lecture video if any of this is confusing. All right, so that's number 3. Let's check out number 4. And on number 4, again, they give you all these different transactions. Let me clear that. And of course, they want you to come up with the balance of each account. And so, again, let's walk you through the cash. So notice with cash, you've got 3 debits and you've got 4 credits. So again, what you do is you add up the debits, you add up the credits, and then take the difference. And the balance down below, you should get, looks like they do get $80,150 as the balance. And double check that again on your math to make sure that it makes sense to you. The rest of these are pretty easy. Accounts receivable, let me illustrate this one since there's only 2 of them. So again, you've got a debit of 5 and a credit of 1,500. So again, what you do is you take that 5,000, you subtract out that 1,500, and of course you're going to get 3,500 debit balance for accounts receivable. That's all you do. Fees income, notice fees income, 15,005, that's going to be 20,000, and that would be the balance. Down below, you'll notice the balance for fees income, they kind of put it right there for you, is your 20,000. The rest of these, you only had one transaction, so that is going to be the balance. And then all you have to do is literally, let me clear that out, just plug it in down here and record the balance down below. But again, this is a good problem just to make sure you understand how to calculate the balance of an account. All right, number 5. We got more of this. And so on this one, they want you to do a trial balance. So again, kind of taking from the last one, you got to put the balance on the debit or credit side. And then they want you to do an income statement. So on the trial balance, you just list all the accounts and then record the proper balance on the debit or credit side. So again, this is the same numbers from the previous problem. So cash, notice cash should have a debit balance. All your assets, notice they're all debit balances. Liabilities is a credit, capital's credit, drawings a debit balance, fees income's a credit balance, and then your 2 expenses are debit balances. Total debits equal total credits of 155. And then all you need on your income statement is your revenues and expenses. So you had 1 revenue, you had 2 expenses, subtract those from the revenue, and you're going to get 14,150 as your net income. All righty, that is number 5. Let's check out number 6. And number 6, we're going to be continuing the theme here. It's pretty much the same problem, except now you're going to be doing the equity. So just a reminder on your equity, remember that you got to copy over that net income. So this is that net income from the previous problem. And then of course you have to subtract out the drawing, and your updated capital balance will be 106,650. That'll be the balance that goes on the balance sheet. So check it out on your balance sheet. You'll see that same balance of 106,650. That's the capital. You had 1 accounts payable. Then you just have to list your assets and make sure that your total assets equals your total liabilities and equity. And again, note the date. The balance sheet always says one date, one specific date, as compared to the income statement and the equity statement where they say for a time period, like let's say month ended. Just kind of make sure you pay attention to those dates. Every now and then that could end up on like a test, test question. All right, that was what we say, number 6. Let's check out number 7. These would be more repetition. These are the same types of transactions you've been doing, except now again you're going to go and you're going to put these into individual T accounts. And so starting off, you've got investment of $42,000 in cash. So you got to think about what accounts are affected. It's going to be cash and capital. You're increasing cash, so you're going to be down here below. Here's the answer: debit cash, and the offset will be a credit or an increase to capital. All right, the second one says you bought equipment for cash, $20,000. So think about what you're going to be doing. You're going to be increasing or debiting equipment. It's an asset, and then you're reducing another asset, which is cash. You're going to be crediting cash. So here's your debit to equipment and the offset of a credit. Remember, your debits have to always equal your credits. Debits equal credits of 20. So the $20,000 gets credited to cash. All right, third one says you sold some surplus office furniture for $3,400 in cash. So you're going to increase cash $3,400, that's an asset, and then decrease office furniture, which is a credit because it's another asset of $3,400 as well. 4, purchased a computer for $3,700 to be paid in 60 days. So that's going to be accounts payable. Your computer is going to be an asset. So it looks like they want you to use office equipment as the name. So they debit office equipment asset and then credit accounts payable, which is your liability. So again, that's number 4. Let's see, number 5 says that they bought office equipment for $22,400 on credit. And again, on credit is the same thing as accounts payable. So you're going to increase an asset for $22,400, you're going to debit it, and then you're going to increase your liability account for the same amount of $22,400. So let's show you that. So here it is down below right here. You got the debit there for office equipment and then the credit to accounts payable. Number 6, and I'm going to, since they got the transaction here, I'll just leave this here. 6 says the owner withdrew $12,000. That's going to be a personal withdrawal. So you're going to debit the drawing account. That acts just like an expense, but it's not. You get the rules of debits and credits are the same though. So you debit drawing, and of course you credit cash because you're reducing it. 7, you bought a delivery truck on credit. Again, that's accounts payable. So you're going to debit the delivery truck. That's an asset increase. And the offset credit goes to, again, accounts payable. And then I think the last one on this one was you had a partial payment of your liability on this one. So you're going to be debiting the liability account by reducing it. That's a $7,200 debit to accounts payable. And then a credit to your cash because you're reducing cash. And then on the analyze part, it says select the transaction that's directly affected owner's equity account. And of course, you can go back and review these and also think about how these, if it is an equity item, remember the equity accounts are like expenses, revenue, and drawing all affect your equity and of course your investments. So as you can see, some of these, like the ones where they say no, like this transaction number 2, that's just a shift in assets. You bought one asset for another asset. The same thing for 3, all you had affected was assets. 4, all you had affected there was you had an asset and a liability affected. 5, same thing, asset, liability. Again, you did not affect equity. And then number 7, same thing, asset, liability affected. And then number 8, asset, liability affected. So those did not affect equity directly. All right, so that was what, number 7. Let's check out number 8. We got 3 more to go. Again, more T account postings, debits and credits. Good practice. So again, these should look very similar to the other problems. So notice the first one, you have an investment in the business for cash, $50,000. So you debit cash, credit capital, just like the other problem. Second one, bought office furniture for cash, $17,000. So you're going to debit office furniture, credit cash. 3, bought a fax machine payments due in 30 days, that's going to be an asset and an accounts payable item. And they probably are going to be using office equipment, and they do. So notice they debit office equipment and then they credit accounts payable because you haven't paid for it yet. That's an increase to your debt. On 4, I'll just leave these illustrations up on this one. 4, you bought a used car for $17,800 cash, so you debit auto, credit cash. 5, another investment in the business, you debit cash, credit capital. 6, bought a new computer, payments due in 60 days, again, office equipment debit, credit accounts payable. 7, paid part of your debt on what you owed, so you're going to debit that accounts payable. That means you're reducing it, and then crediting cash because you're reducing your asset there. And then finally, a withdrawal on the last one, you simply debit a withdrawal and then credit cash for the amount that they're withdrawing. And then, of course, on the analyzed part, let me show you that. And then they want to know which transactions affected each asset account. So go back and review the transactions and make sure you know which accounts affected assets. Of course, on this one, I believe every one of them had an effect on an asset account. All righty, that is number 8. 2 more to go. All right, on 9, again, more practice on your T account debits and credits. And again, since they got these descriptions down below, I'm going to go right to the answer since it's easier to show it this way. So purchase office supplies for cash, so you increase debit office supplies, decrease or credit cash. The second one says delivered monthly statement, that's going to be a revenue item, and you collected it, so you're going to debit cash, increase. Credit fees income, that's an increase to your revenue. Next one, paid the rent expense for the month, or the rent, so debit rent expense, credit cash. On 4, it says that we billed a client for $16,000. That means they have not paid us yet. So debit AR, credit fees income because you did the work, you've earned it. That's revenue. 5, paid fee for weekly counseling from previously billed. So we had owed somebody else. Oh, I'm sorry, a client paid us. I'm sorry, I misread that. We had done the work. They owed us the money, so you're collecting on a client. So you're going to increase your cash and decrease that accounts receivable. You're shifting the asset. You're basically, I mean, this is a good thing. You're collecting your cash. All right, so then we got 6. Paid the salaries, $18,400, so that's an expense, debit, credit, cash. Same thing on 7, another expense, debit, expense, credit, cash. Notice the same amount, so there's always a debit and credit offset. 8, billed a client, so that's going to be an accounts receivable. You did the work, so you're going to go ahead and credit revenue. 9, purchase office supplies, so you debit office supplies, credit accounts payable, because on account means you haven't paid for it yet in cash. And then see, we've got 10, which is paid your salaries, again, $18,400 debit, credit, cash. 11, another collection, so you debit cash, you collected your cash, and then you're collecting it from accounts receivable, so you credit accounts receivable. And then finally, we had some cash revenue, debit cash, and then credit fees income. And then you just have to get to the analyze part, and you don't know how much cash did the business spend during the month. They say $59,380, and then you just have to go to all your cash and add all those up, and you should be able to come back to that $59,380. I think that's it. All right, that's 9, and the last one, number 10. Notice letters A through S, more practice on debits and credits. And so again, let me page down. So on this one, what they did was they set up one cash account for all your cash transactions rather than having individual cash T accounts. You just have one T account for all the cash transactions, and same thing with AR and office furniture and so forth. So you can see again how they label each transaction. So again, these are a lot of repeat stuff, but let's walk you through it. So first one, invested cash in the business, $90,000. So you're going to have cash and capital. So notice again, you're going to be debiting cash 90, and then your capital account somewhere, here it is right there. There's your credit to capital of 90 right there. All right, next one says you paid $6,000 for the month's rent. Of course, we know that's going to be cash and rent expense. So notice here's your cash, $6,000, and of course you should find a corresponding debit to rent expense somewhere down below. Let's go down. There's a 6,000 debit right there. That's letter B. Letter C says you bought office furniture for $10,580 cash, so we're going to be crediting cash. And it's the office furniture. There's your $10,580 right there. There's your debit there. And of course, there's the offset right there. That was what letter C. Letter D, perform services. That's going to be revenue and cash. So let's see, we're going to be debiting cash for $8,200. Then go to your fees income. You can hopefully see letter D. There's your $8,200 on fees income. Letter E, you paid your telephone bill, $1,250. So note that here's your credit to cash, and then your telephone expense should be down below somewhere. Here it is, there it is. So there's your $1,250 right there. There's your debit to that. So that's letter E. Letter F, let me clear that. Performs, again, every time you see perform services, because these are service businesses, that's going to be revenue. It says on credit, that means accounts receivable. So you should see a $14,000 debit to accounts receivable right there, and then your $14,000 credit to fees income on letter F right there. Letter G says you purchased a computer copier for $18,000, paid $7,200 into cash immediately, and the rest is on account. So basically, the $18,000 computer and copier, let me show you that. So they're going to have that part right there. That, again, this is letter G. There's your debit there. And then for cash, notice this that they paid, where is it? $7,200 in cash. And that means that the rest of it is going to be on accounts payable. Well, that's going to be $10,008. So this $10,008 right here, notice it says letter G, that's all part of the same transaction. So if you take $10,008 plus the $7,200, that gives you total credits of $18,000, which offsets that debit of $18,000. Okay, so be careful on this, on that one. All right, so that's what letter G. Letter H said you received $7,000 from credit clients. So that's simply just an increase or a debit to cash, a 7, and there's your credit to accounts receivable. And that's letter H. Letter I says you paid $2,800 in cash for your cleaning services. So you'd be crediting cash for $2,800, and then cleaning services, I believe they're going to have you put that under miscellaneous. There's that debit down there. There it is, letter I. Letter J, purchased additional office chairs for $5,800. Received credit terms, so this is an accounts payable. So there's the, this is fine accounts payable. There is the $5,800 on J, and then the offset goes to office furniture debit. Letter K, purchased office equipment, paid half immediately. The balance is due in 30 days. So office equipment, there's the $22,000. So you should find 20 or 11,000 of that credited to cash, and the other 11,000 gets credited to accounts payable because that's what you owe. All right, that's what letter K. Let's see, letter L says issue check to pay salaries, $9,400. So you see $9,400 credit to cash and a $9,400 debit to salaries expense. That was L. Letter M is perform services for cash, $14,500. So debit to cash, $14,500, credit to fees income, $14,500. You've got perform services on letter N. On credit, it's the same thing, except it's going to be debit accounts receivable, and then credit fees income. Let's see, letter O, collected $8,000 on accounts receivable. So $8,000 debit to cash, $8,000 credit to accounts receivable. That's letter O. Letter P, issued check, partial payment of what you owed. So credit cash, $2,900, and debit accounts payable, $2,900 on letter P. Letter Q says paid $725 to a duplicating company for photo work. So you're going to be crediting cash to $725, and then most likely miscellaneous expense debit $725. That's Q. R says you paid the monthly electric bill $1,280, credit cash $1,280, debit most likely utilities expense. There it is, debit utilities expense $1,280. Letter R. Finally, letter S, they withdrew $5,500 in cash for personal. So credit cash, and then your drawing account, there's your debit. And then also notice in this problem that you should also be able to get the balances of each account. So make sure you know how to get that 69050. Again, if you've forgotten, remember what you do is you have to add up your debits, add up your credits, and then simply take the difference. And practice, this is a good practice problem on analyzing, and is also knowing how to get a balance of each account. And then of course they wanted to know which transactions affected your liabilities. See if you make sure you can come up with that 24,700. And again, if you have any problems or questions on this, let me know, email me. Remember, you have unlimited attempts on all the homework assignments as long as you get them submitted, again, by the due date.